Welcome back, everybody, to We Are TPM with myself, Kyle Teixeira, sitting next to this guy, John Teixeira, and we are going to get into this week, upgrading your portfolio. If you'd like to discuss this or anything else we talk about, or just talk to our smiling faces over the phone, give us a call, 817-818-9039. Shoot us an email at showmethemoney@wearetpm.com. John, what are we talking about? Upgrading your portfolio? This is like a software update?
No, it takes a lot more effort. A lot more effort than a software update. I wish it was a click of a button. That would be cool, wouldn't it? There's a lot of people out there that have older homes in their portfolio. We know some people that their entire portfolio is older homes. And when I say older, 40, 50-year-old homes that were born in the 70s and 80s, right? There's a lot of those around in our market.
And I guess the reason we're bringing this up is because they're hurting more than they're in recent years. You know, a lot of the things we've talked about and follow up our last episode with more of a solution-based thing. We talked about it last week that there was, there's a lot of high costs now. There's high repair costs, high maintenance costs, high insurance costs, high taxes, high values in some cases. And all those things have combined and gotten worse very quickly after the rent rate increases went on, right? And people are starting to feel the pain of like, okay, there's repairs and maintenance on these older homes that are 50, 60, 70 years old, maybe even less, but 40 years old, whatever it is, the maintenance and depreciation and all that stuff of what's in there adds up. And it costs a lot of money, and it starts to cost you even more money. It seems like it's never ending, and then you're seeing a lot of investors in this scenario just selling these portfolios. And when a bunch of these portfolios hit the market, or a lot of these houses hit the market, it hurts values, all those things. So what are we talking about? We're talking about upgrading it. And I really see two ways to upgrade your portfolio that can improve these things. We've always been a representative of that. If you're going to take on an older home or beat up home or whatever it be, upgrade that home. That's step one. Like, completely renovate it and make it a newer home.
Right.
Or if you have an older home, you likely bought it a while ago, and you likely have a good amount of equity in it. So the main point for ours that we've seen a lot of investors successfully do recently is 1031 exchanges. So at a high level, you take, maybe something you bought for $50,000 and is worth $200 now, and that $150,000 gain gets rolled into the down payment, for example, for like a much newer home that gets much more rent and has much less repairs and likely has a higher rent rate. So
we talked about how people are focusing on their cash flow and their monthly output and the expenses. And like you said, repair costs are just going through the roof lately, and everything seems to be going through the roof, and rent rates have flattened out. So that's causing this problem we've been talking about over the past couple podcasts. And so to upgrade that portfolio, I actually did this a long time ago, right? I sold a home built in 1979 or something and bought a foreclosure back during when foreclosures were plentiful, and almost at the same price, right? That was built in 2005, right? And so that was an upgrade of that home in my portfolio. And so now is another time to possibly be doing that, right? Because you can do, like you said, you can do that 1031 exchange. You can still get things a little bit cheaper right now before we kind of, if we try to predict, the future, we could be in one of those moments where things kind of start to take off again, right?
We definitely could. So, and we're not trying to predict, but at least you have to predict to some level, right? What I will say is I don't think interest rates are going any lower. They're probably going to stay steady, or there's even talk of them going higher. But regardless of that, they're in a comfortable zone to start making these changes, and it's something that I think can be advantageous, because what are a lot of cash flow investors, especially even appreciation, if you look at it from what is hurting the annual cash flow, well, what's came recently after all the rent increases of like 2020, 2021 came after that is like high insurance costs, high taxes based on values, and high repairs and maintenance. Well, what can we work on there? We can't really work on the tax part, not much you can do with that. Insurance, well, insurance in these older homes and these maybe even less valuable homes is actually proportionally higher than in the higher end homes, because they're way higher risk, and these premiums are taking on that risk of the age and all those things, and repairs and maintenance. So if I get a home that's 10 years old, just forgetting all the other numbers, 10-year-old home it should have less repairs and maintenance, should have been built better than something that's 50 to 70 years old.
Right.
So you can reduce the repairs and maintenance there and roll in your equity to, say, a down payment on, in my previous example, a house worth $200,000, roll that into a house worth $600,000, or put $200,000 down on it, and your appreciation level will be higher because the value is higher. Even if it's still the same percentage, like 3% a year, which we like to use, 3% of $600,000 is more appreciation than 3% of $200,000. So,
and using the 1031 exchange allows you to
avoid
the capital gains tax that might be there.
And that's why we call it rolling it over.
Right.
But what else changes? You get higher rent rates. You have a higher mortgage. We'll admit that. Maybe at a higher rate, but what if you end up with the same cash flow? So if you have the exact same cash flow difference after that new mortgage, and doing everything I just said, well, you should have less repair and maintenance hits. You should have longer staying tenants. You should have more proportional insurance. I'm not going to say it's cheaper, dollar wise, but proportional to the value of the home, it should be more proportional. So
the newer homes, you're absolutely right. We tend to find a lot less maintenance issues and tenants that stay a lot longer in the newer homes, right? So what about
just better tenants leads to cheaper make-readies, right? Turnovers, because
that too.
So
yes,
not
absolutely.
Just repairs and maintenance,
and
but,
that's
how much
part
does
of
it get trashed?
Right, right. And that's part of the rent rate too, right? So if you go into a brand new neighborhood and you're kind of setting the market with rental rates there, right? And you set it real high and you get good tenants because people want to live in this new neighborhood, like you said, that's going to create a much better situation for that investor regarding the turnover and how they take care of the home, how long they live in the home, the whole bit. So everything about that situation is better, even though the cost of the home, the initial capital of the home, is going to be more. But let's look at the flip side. The other option is that you put capital into an old home, right? So you're still putting capital into either a new home or an old home. Now you got to put, let's call it $40,000, $50,000, $60,000 into a new home to make it right. And you know what? We didn't even talk about this. Here's one of the problems with doing that. When you do all the cosmetics, change appliances, change the floors, paint inside and out, do all the stuff, change the water heater, maybe we even change the AC. Seems like we've gotten everything, doesn't it?
Doesn't fix this 50, 60-year-old drains, does it?
You know how many thousands of
cast
dollars
iron under the ground
we've spent replacing cast iron drains? I mean, and then you're digging under the slab and
But you can replace all that too. Like that's truly upgrading.
You can if you're smart and that's what you want to do. I mean,
but
yes.
A lot of people don't, and then the rest of it suffers from that, right? It's like, well, if your drains aren't replaced and you built this beautiful shower that's connected to all the cast iron drains, and now you got to destroy half of it just to replace the drains that you didn't replace when you did the remodel. That can lead to higher things too. So.
Nobody ever does the drains unless there's a drain problem, right? That's just the bottom line.
I wouldn't say nobody. We did. We've done it because we've seen the pain of it. So,
so that's the flip side, right? So,
but I love the and that's I've talked to a lot of people. It's harder for investors to wrap their brain around sometimes, but I've seen investors that do this with a lot of success. But like your scenario of upgrading like the current home still involves additional cash. There's a lot of equity positions out there where what I just talked about gets you upgraded and basically reestablishes the longevity of the investment without essentially costing you any more cash out of your pocket.
Right.
It's like resetting. And I think the appreciation part of that's huge. Like if a 600, if you know, everything I described is essentially moving money around, right? Even if it all comes out to the same. Well, if a $200,000 house doubles in 10 years, that's $200,000 more of appreciation, right? If a $600,000 house doubles in 10 years, that's $600,000 worth of appreciation because you moved money around 10 years ago, right? You upgraded it. You upgraded that investment. So, and yeah, most of the time that's done via selling, but you sell with the 1031 exchange in order to get something else. So we have a whole episode about 1031 exchanges and could do a whole nother one on 1031 exchanges, but the simple way is take all your gains from one real estate investment and move it into another real estate investment within a certain time period, like 90 to 120 days, but still. It's a swift movement. So there's a lot of people doing it right now. So, and generally these upgraded homes, if you target strong rent areas in, strong, high value markets with good school districts, and, that can strengthen your rent demand and how stable you are with rent in any market.
Yeah.
Because one thing we've seen is that like really great school districts hold up rental markets even in down markets more than the opposite. So
yep, absolutely. So I mean the amount of money, you're going to take that appreciation that you have in that old home, you'll probably spend some of it to fix it up so you can sell it and get top dollar for it, right? So you sell it, you use it, and then you use that for the down payment on the new home. Like you said, it's probably not costing you anything at all, right? And if your down payment is, I don't know, it could be as low as 5%, right? Most investors are probably going to put a full 20% down, so they don't have to pay PMI and all that stuff. But it could be as low as 5%. And how does that compare to the renovation that you would have done?
Most investment loans are going to require you to be 20%. But yeah, I mean, like even in my example, the $200,000 is 20%.
Yeah.
So we call it upgrading because it is literally an upgrade, right? It's literally a newer one. So, when we're looking at bigger portfolios, sometimes I just talk about like, what's your average age of home? If your average age of like 20, 30 homes is in the 60s, 1960s, or if it's in the 70s or it's in the 80s, like it didn't used to sound so old, but even a 1980 home is 46 years old. 46 years old. So, and that 40 to 50 mark is when you start seeing, in our experience, is when you start seeing a lot of the dilapidation of the home if it isn't taken care of, if it isn't not just preventative maintenance, but replacing of things, right? Like we're talking about Texas, where a lot of homes, especially in the 80s, have cast iron drains that were placed into clay, and there's a lot of movement. So,
and speaking of the clay, I mean, we just started in the early 2000s pouring foundations that could better handle the gumbo clay that we're on here in Texas. Now, if you're listening and you're not in Texas, you don't know what I'm talking about, then you don't really need to know what I'm talking about. But it's something we deal with here regionally.
And Northeast, you got basements that are 60, 70 years old. I imagine that's a problem, right?
Well, but houses move, and over 40 or 50 years, what causes them to move is somebody not taking care of that foundation, right? Somebody not maintaining the landscaping around the home. Maybe it went vacant for 6 months for some reason. There's so many things that could cause that foundation to start failing over that long period of time that a newer home the foundations are poured better. They're usually poured down into the ground a little bit better. In some cases, they're even poured on top of piers that go down to bedrock if you're really good. But the point is, the technology's gotten better so that we worry less about foundation problems with a home built, I don't know, I want to say 2005 or later.
Yeah, and we're just talking about things that that affect investments that a lot of people don't consider or see, like plex piping, right? Like the water lines that don't bust in freezes, which sounds unheard of in Texas. But like, what's the tenant experience as well? Like, do tenants stay longer in these higher value homes because they have cheaper electricity bills because the windows were installed within the last 10 years because they're newer? Does the AC run more efficiently? Does all the LEDs in the house run more efficiently? Like, people move into these older homes and move out after a year because they don't like the $700-800 electricity bills.
Or they're getting drafts in the windows. And
a lot of
absolutely.
little things that do add up to a home's efficiency. There's new homes that are commonly built with radiant barriers, with spray foam, and all this stuff that is little and adds up but does add value to your investment and also add value to the tenant experience. Because there's people in $2,000-3,000 a month homes with cheaper electricity bills than the people in the $1,000 homes and pretty similar sizing, right? And you could have the same AC unit. It's not the efficiency always of the AC unit, but the efficiency of the home will affect the life of the AC unit, right? We see these AC units last 3 to 5 years in these older homes and 15 to 20 in the newer homes, and it's just the strain on the unit. So we can go on and on about how this newer technology can help the investment have a better longevity, but we are seeing a lot right now with the higher cost of all of these things we've mentioned make it more noticeable for people. So.
Yeah, and I don't want people to think also that we're suggesting that this is the way you have to go, because if you're going to renovate a house, that's fine. Just the thing is, it's about mindset, right? It's about understanding what you're doing and categorizing it correctly. Mm-hmm. Some people buy an old house and then
they see a deal.
Years later, they see a deal, and then they don't do anything to it. Maybe it's tenant occupied, so they don't do anything to it. And then years later, they have to put money into it, and they categorize that as repairs. And then they look at it like, well, I had to do $25,000 in repairs, and this is killing me, and it's taking all my cash flow. Well, if you look at it as you bought this house $75,000 under value and didn't do anything to it, if you had done that work right up front, you would have called it initial capital. You wouldn't have called it repairs, right? And so sometimes it's just about recategorizing in your brain the capital and the assets that you're using to either purchase or manage that home, right?
Yeah. And chopping things up never makes them cheaper. Makes them more expensive, right? So if I send a contractor to go replace 4 doorknobs all at once, it's going to be cheaper than if I send him 4 separate times to do 4 separert doorknobs, right?
Yeah.
And that's a simple example, and ironically using doorknobs, but like the time it takes him is less, because you can knock out 4 all at once instead of, everybody knows how that works, right? But it's no different with doing all the work up front on a people do fix and flips. Well, how much do you fix it? Do you Band-Aid it? Do you replace their leg? You replace all the arms, that kind of thing. Because if you do it up front, it matters. And it also helps on your tax basis, cost basis, all those things. You write it off up front. So we're not discouraging upgrading or we're not discouraging the purchase of these old homes at all, actually. You got to sell it to somebody to even do what we're talking about. We're more coming to a solution of a lot of people are realizing their losses, as we talked about before, in a down market where there are deals.
By selling.
And it's like you're in a good market to do what we're talking about because you're getting deals on values because there's a lot of fear in the market because of what we just talked about. And you can,
if you're in this for the right reasons and you're an investor and you've got appreciation, what we're saying is instead of selling, if you're considering selling, upgrade your portfolio.
Mm-hmm.
Like,
Yeah, I mean, you could have
flip that
50
thing into
homes,
something better.
and it's not always a number. You know, you could go really big and get some really expensive homes. So take 50 old homes and turn it into 30 new homes, you know, depending on how the numbers work. But, you know, less quantity does matter. Do you think you're it doesn't matter if it's old or new. If you have 50, do you think you're going to have more repairs and maintenance than if you have 30? Well, if you have less quantity of homes, you're likely to have less repairs and maintenance, right? That lowers that. And if all the other numbers stay consistent, you're in a better position. So I think looking at, if you have a portfolio, even if you have a single one, looking at those things can matter.
I think I would rather have 30 brand new or near new homes than 50 old ones for sure. 100%.
And even if you don't, like, what are you going to think in 10 years? You know, now it's 70 years old, or in 20 years, it's 80 years old.
But in 20 years, that's the thing. It's within my lifetime. It's not going to age so much that it's going to age me out of that investment, if that makes sense. Like I'm going to use the resources from that investment most likely, unless I pass it down to my kids. But if that's my retirement plan, or that's my out to go to Costa Rica, or whatever I'm doing, then that's going to happen within that time frame that we're talking about for a home to get dilapidated.
Yeah, and I mean, we could it could not even be age and upgrading in that form. It could be upgrading the area. It could be moving to a different market that is very comparable home, just in a better market, stronger market, with a 1031 or whatever. You know, it may be.
I'm not gonna call any areas out, but there are areas in our market that if you were investing in when things went really bad, I would be getting out of those areas when things are good. Right?
Yeah.
Because those areas typically, when everything goes bad, those are the areas that always go really bad, right? And then things come back, right? Everything's cyclical, but when it comes back, get out and go buy yourself a house in Arlington or something, you know, somewhere where you know things are going to be stable and steady.
Or predict forward. The market. You know, we talked recently to a guy that goes 20 miles. He uses a 20-mile radius. He's like, I find the most heavily, developing areas, and I go 20 miles out to the next city, and I buy anything I can in that city, and then I wait 10 years when they start developing that one, right? We've seen that. That's like everyone who jumped down to Midlothian and started buying down there, or Mansfield.
Yep.
They made out pretty well.
Yep.
So, it's an upgrade because it's an intentional. We're calling it an upgrade because take some intention before you just realize those losses and with nothing else to do with it, right? Like, make a move of that investment.
Yep.
It's very possible. So, I think if you don't have anything else to say,
I don't.
That's how people have it.
I think we killed this one.
Love it. So if you want, to look at options on upgrading your portfolio or discuss anything related, give us a call, 817-818-9039. Shoot us an email at showmethemoney@wearetpm.com. Check out our site at wearetpm.com if you want.
Fancy new site. Kyle's proud of it. He's worked hard on it.
And John and Kyle are out.
We got